Imagine you're a trader at Citigroup on January 29th. Your eyes are glued to the screen as 12,000 silver contracts race towards expiration. You've made a promise, a binding legal promise, to deliver 62 million ounces of physical silver to your counterparties. They have every right to demand it, but there's a massive problem. The COMEX to warehouse system, the very system you rely on to fulfill these promises, only holds 31 million ounces of registered silver available for delivery. You've essentially sold tickets to a concert where half the seats simply do not exist. This isn't a wild guess or some conspiracy theory. This is simple, cold, hard math, all documented in public regulatory filings. These documents paint a picture so alarming it should be giving every derivatives trader sleepless nights. Let's break it down. According to the Office of the Comptroller of the Currencies report for the third quarter of 2025, Citigroup holds a staggering $6.3 billion in silver derivatives. That's not just a number on a screen. It represents a contractual obligation for 83 million ounces of real physical silver. That's metal that real people and institutions can demand when the contracts settle. Now, here's where the numbers get truly terrifying. As of January 9th, the total registered inventory on COMEX, the actual physical deliverable silver sitting in approved warehouses, is just 31 million ounces. Let that sink in. Citigroup's exposure from just one single bank is 2.7 times larger than the entire deliverable supply available on the very exchange where these contracts are traded. Think about what that ratio really means. Imagine you held a futures contract that entitled you to physical delivery of silver. Then you discover that the bank on the other side of your contract had promised that exact same ounce to two other people. What would you do? You'd demand delivery immediately. You want your physical metal in your hands before the music stops and someone else gets what is rightfully yours. This is precisely the pressure cooker situation building as we approach January 29th. That's the last trading day for COMEX January silver contracts. On that day, every single open contract must either be settled with cash or fulfilled with physical delivery of the metal. As of right now, there are still 2,400 contracts open, representing a colossal 62 million ounces of silver. The holders of these contracts now face a critical choice. They can either accept a cash settlement, likely based on the COMEX paper price of around $76 an ounce, or they can stand for delivery and demand the physical silver they are owed. If even a fraction of these contract holders decides to take the physical metal, the system faces an unprecedented crisis. Remember, there are 62 million ounces being demanded, but only 31 million ounces available in the entire registered stockpile. It's a game of musical chairs with half the chairs missing. What happens when the music stops on January 29th? Will the exchange default? Will they change the rules at the last minute to force cash settlement? Or will a desperate scramble for the few available ounces send the physical price of silver into the stratosphere? The entire situation exposes a fundamental weakness in the derivatives market, where paper promises have grown far larger than the physical reality they are supposed to represent. The promises made on paper are about to collide with the hard limits of the physical world. This isn't just a story about silver, it's a warning about the stability of our entire financial system. Keep a close eye on this, because what happens next could have ripple effects far beyond the world of commodities. Thanks for watching, and be sure to subscribe for more updates on this developing story. Normally, a little tightness in the silver market wouldn't be a big deal. Most futures traders are just speculating. They don't actually want a truckload of metal delivered to their door. They just take a cash settlement and roll their position. But right now, we are far from normal. Something huge happened on January 1st that completely changed the game for global silver supply. China rolled out new export licensing rules. Their Ministry of Commerce now requires any silver exporter to prove they can produce over 80 tons of silver a year. Just like that, this single rule wiped out 90% of China's silver exporters. These weren't small players either. Collectively, they supplied about 15% of the entire global market. This isn't some temporary hiccup or a policy they might walk back. It's a permanent structural removal of around 250 million ounces of silver from the market each year. Now, let's connect the dots. Big Western banks, like Citigroup, have built up enormous positions in derivatives. They've been operating under the assumption that they could always get their hands on physical silver if they ever needed it. China's exports were their safety net, their reliable backstop. Whenever inventories on the COMEX exchange got tight, these banks could just dip into the Chinese supply chain. Well, as of January 1st, that safety valve has been welded shut permanently. The registered inventory on the COMEX has already dropped by a staggering 70% since 2020. And guess what? That supply from China isn't coming back to refill it. Ever. So you might be thinking, how is the market reacting to this? This is where it gets really fascinating because we're witnessing a historic split between prices right before our eyes. On January 9th, the spot price for silver in Shanghai was trading at a massive premium, about $8 to $10 higher than the price on the COMEX in New York. That's a 10 to 13% difference. Physical buyers in Asia are actually paying around $86 to $90 an ounce, while the paper markets back in New York are still quoting prices between $76 and $80. Just think about what that gap means. If you could buy a COMEX contract for $76.6 and immediately sell physical silver in Shanghai for $86, you'd make a risk-free profit of $10 per ounce. The catch? You can't, because there's no physical silver available to actually make that trade happen. You can't convert those paper contracts into real deliverable metal. That's exactly why this premium exists. It's not some temporary glitch that traders can just arbitrage away. It is mathematical proof that the paper market and the physical market have fundamentally broken apart. This premium is sending a clear signal. Buyers who need actual physical metal are willing to pay up to $90 an ounce. Meanwhile, paper traders who never plan on taking delivery are happy to keep trading bits of paper at $80. This puts banks like Citigroup, who are holding massive short positions in these derivatives, in an absolutely impossible situation. They've bet against the price of silver, assuming they could always deliver the physical metal if they had to. But now, the physical metal is disappearing and its price is detaching from the paper contracts they've sold. What happens when a market promises delivery of something that no longer exists in sufficient quantity? This is a question that doesn't have an easy answer, and it's a situation that could have ripple effects far beyond just the silver market. We're in uncharted territory here. The foundation of the paper silver market is being tested like never before. What happens next is anyone's guess. But one thing is certain, the rules of the game have changed and the old assumptions no longer apply. Thanks for watching. Be sure to subscribe for more updates on this developing story. Let's break down the mechanics of a financial event that is unfolding right now, one that could redefine the precious metals market. We're not dealing with speculation or rumors here. Every number I'm about to share comes directly from official regulatory filings and market data. This is about simple, unavoidable mathematics. Right now, major banks have sold contracts for silver priced around $76 based on the COMEX paper markets. But there's a huge problem. If the people who bought those contracts decide they want actual physical silver instead of just cash, the banks are in serious trouble. Why? Because to get that physical silver, they have to buy it from physical markets, like the one in Shanghai, where prices have already soared to between $86 and $90. Think about that. For every single ounce they're forced to deliver, they lose $10 to $14. Now multiply that by their total exposure. We know from official filings that just one bank, Citigroup, holds derivatives representing a staggering 83 million ounces of silver. If even a small fraction of their clients demand physical delivery, we're looking at potential losses climbing from $830 million to over $1.2 billion. And that's just the beginning. Those losses assume the price gap between New York and Shanghai stays where it is. But what happens when the word gets out that COMEX might not be able to deliver? What happens when industrial buyers, who actually need silver to make things, realize that a major source of global supply is suddenly cut off? This is where it gets critical. Solar panel manufacturers, for example, consume 150 million ounces of silver every year. It's a key component in photovoltaic cells, and there is no viable substitute at current technology levels. These aren't speculators. They're businesses with production contracts to fulfill. They need physical silver. When they discover that Chinese exports are blocked and COMEX inventories are dwindling, they won't care about the paper price. They will pay whatever it takes to secure the metal they need to keep their factories running. This sets the stage for a perfect storm. Let's look at the numbers heading into the critical delivery period, starting January 29th. We have contracts representing 62 million ounces that must be settled. Citigroup is on the hook for derivatives covering 83 million ounces. Meanwhile, the total amount of registered, ready-to-deliver silver in all COMEX warehouses is just 31 million ounces. The math simply doesn't add up. The paper game is ending, not because of some grand conspiracy, but because contractual obligations are smashing into the wall of physical reality. When you promise to deliver 83 million ounces of something, but only 31 million ounces are available, something has to give. This brings us to a crucial point of concentration risk that should sound alarms for anyone who remembers 2008. The latest official report on bank derivatives shows that U.S. banks hold a total of $9.5 billion in precious metals derivatives. Here's the shocking part. Citigroup alone accounts for 66% of that entire exposure. One single bank holds 2/3 of the U.S. banking system's precious metals derivatives. Does that sound familiar? It's the exact same pattern of concentrated risk that brought down giants like Bear Stearns. Bear Stearns collapsed because its exposure to one asset class, mortgage-backed securities, was so massive that when prices turned, the losses wiped out their entire capital base almost overnight. Now, look at Citigroup through that same lens. Their derivatives aren't just numbers on a screen, they are legal contracts. Their counterparties have the right to demand physical delivery. If just 20% of Citigroup's 83 million ounce exposure demands physical settlement, that's 16.6 million ounces they must find. They would have to source more than half of the entire registered inventory on the COMEX. This isn't a hypothetical scenario, it's a mathematical pressure cooker. As we move into the February settlement window, the banks holding these short positions face three choices. One, they can try to buy scarce physical silver on the open market, likely driving prices even higher. Two, they can try to pay their clients a hefty premium to settle in cash, admitting they can't deliver the metal. Or three, they can go to the COMEX and beg for emergency rule changes to save them from default. Every one of these options reveals the same core truth. The paper promises have far exceeded the physical reality. A resolution is coming, and it will be forced by simple mathematics. We are watching the early stages of a squeeze driven not by speculators, but by industrial demand and contractual obligations colliding with a finite supply. Keep a close eye on these markets. Thanks for watching. Hey everyone, and welcome back. Today, we're diving deep into a situation unfolding in the silver market that is unlike anything we've seen before. We're not talking about technical charts or investor sentiment today. We're talking about a fundamental mathematical reality that could soon send shockwaves through the global financial system. Let's start with a simple fact. For many industries, silver is not optional. Solar panel manufacturers can't just swap in aluminum without a massive redesign and a hit to efficiency. Electronics makers need silver for its unmatched conductivity. Medical device companies rely on its unique antibacterial properties. This isn't like gold, where investors can choose to buy or not. For these industrial giants, securing physical silver is a matter of survival. They either get the metal or they shut down production lines and default on billions in orders. And that's where the problem starts. A massive player, Citigroup, is reportedly short a staggering 83 million ounces of silver. They've made a bet that the price will go down, but they're making that bet in a market where industrial buyers will pay any price to get their hands on physical metal, where China has permanently taken its exports offline, and where another major trading desk has quietly gone long, accumulating 750 million ounces of physical silver. The banks that saw this coming have already repositioned. Those who didn't are now facing a mathematical certainty. There simply is not enough physical silver to cover their paper promises. Let's look at the numbers, using publicly available data from the CME Group. In December 2025, the registered silver inventory at the COMEX exchange was draining at a rate of 2.1 million ounces per week. This isn't a one-time fluke. It's a sustained pattern of physical withdrawals. At this rate, the entire registered inventory, all the silver available for delivery, will be gone by March 28, 2026. That's just 12 weeks from when the Chinese export restrictions kicked in. 12 weeks until the primary exchange for silver runs completely dry. Now think about what that means for the March silver contract, which is historically the biggest delivery month. The last day to trade that contract is March 26th, just 2 days before the vaults are projected to be empty. Anyone standing for delivery will be demanding metal from a system on the verge of collapse. The COMEX will face an impossible choice, either default on its delivery obligations for the first time since the 1930s, or change the rules and forbid physical delivery. Either way, the credibility of the entire paper market is destroyed. So, what price would silver need to reach to avoid this crisis? This is where industrial demand provides a hard price floor. On January 6th, solar manufacturers in Tokyo were already paying $130 per ounce for immediate physical delivery. At the same time, semiconductor plants were contracting silver for early 2026 at $145 an ounce. These companies are already paying double the paper price because they know that paper promises don't run a factory. For a solar company with billions in orders, the cost of silver is a tiny fraction of their expenses. They will gladly pay $120 or $150 an ounce to keep their lines running. That alone suggests an upside of 58% to 97% from the recent baseline of $76. But that's just the floor. That doesn't account for what happens when investors catch on and panic buying begins. Let's look at history. During the Hunt brothers squeeze in 1980, silver went from $6 to nearly $50, a 725% gain. And that was driven by speculation. Today's situation is driven by a real, permanent supply deficit. The silver used in solar panels is gone forever. If a speculative squeeze caused a 725% gain, what could a real physical shortage do? Mathematically, prices of $200 to $267 per ounce are not out of the question. Keep your eyes on these critical dates. January 29th is the first test. When January contracts are due, we'll see if traders accept cash or demand physical metal they know is scarce. Then, watch February 1st to the 3rd, the delivery window. If you see premiums in Shanghai spiking, it's a signal that the physical squeeze is on. But the real showdown is March 26th, the last trading day for the massive March contract. With far more paper claims than physical metal, something has to give. Either the price skyrockets to discourage delivery, or the exchange itself breaks. We are heading into an unprecedented situation, and the clock is ticking faster than anyone wants to admit. This isn't just another market forecast.